Hi, my name is Nathan Davis. I'd like to give you a mortgage market update for the week ending October 26th. So we only have about 2 months left here in 2018. It's certainly been a kind of a crazy last few weeks as we've seen interest rates kind of climb to levels that we hadn't seen in a long time, really since 2009. Right now, rates are trending at around 5%, even 5.125% on a 30-year fix, depending on whether you're looking at an FHA or conventional loan. Right now, there's a fair amount of instability in the mortgage bond market, so we certainly have to keep an eye on things. So, just a couple things to talk about. One, rates are about 1% higher right now than they were this time last year. So certainly quite a bit higher, than we've been used to. We saw a fairly aggressive move, about 0.25% increase in rates just in the last couple of weeks. But really, where we're at is where we expected to be by the end of 2018. When we really looked at all the signs coming into this year, it was expected that we would be here, and sure enough, this is where we're at. Now we've seen, the stock market not do very well the last several weeks, yet that has not helped mortgage rates. In the past, it usually would. So that tells you right now that rates are pretty primed to continue on this upward trend. So we'll continue to keep you posted and see what happens. Now, some additional commentary, is this really going to affect people buying a home? And when you go back and you look at historically, and I've actually shared a little bit of a video with you. It's kind of a cute video, cartoonish, that our company put out. That kind of goes back in time where rates were, where we've been, and kind of just giving us everything's going to be okay kind of outlook. Realistically, where rates are at now is where they should be. They were artificially low for several years because of the Federal Reserve buying mortgage-backed securities. They've stopped that, and now here's where rates are at. We've sold a lot of homes when rates were where they're at now and even higher. So I don't really foresee this affecting people buying homes. We do have to keep an eye on affordability because right now you have higher prices and higher interest rates. The question is are incomes of individuals going to keep up with that pace? As long as they do, it won't really change housing much. When they don't, then that's where we need to get concerned. So again, I'll keep an eye on mortgage rates and let you know if we see any big changes here before the end of the year. The other thing I want to share with you is a new down payment assistance program that we're doing here at Hamilton Group Funding. And I haven't talked a lot about down payment assistance programs in the past because frankly, where there was the advantage for down payment assistance, there were a lot of disadvantages that I just didn't see were good for a customer if they had the ability to put money down. Now, a lot of customers will call me and say, Nathan, I'm a first-time home buyer. And with the expectation that they get something different than somebody who's not a first-time home buyer will get. And that's not really the case. Keep in mind, we can do FHA loans 3.5% down, conventional loans 3% down, and not even have to be a first-time home buyer. But where the first-time home buyer concept kind of comes into someone's mind is down payment assistance. So this new program called Chenoa is tied to an FHA loan. It basically gives them 3.5% toward their down payment. Now it's in the form of a second mortgage. It is repaid, so it's not free money, but it basically allows them to come to the closing with 0% for a down payment. Now they still have closing costs, but you can still have the seller pay some of those closing costs as part of your negotiations. What makes this one better than the others are really kind of two things. Number one, better debt to income ratios allowed on this program. One of the downsides of so many down payment assistance programs is they're so restricted on debt to income ratio that your client qualifies for $30,000, $40,000 less than they would without down payment assistance. Well, right now we know it's kind of hard to find homes, really under $200,000. So, again, it restricts a lot of clients. So this program, a little bit less restrictive on that, which is what I really like. Number two, less fees. The thing is with some of these other down payment assistance programs, they give you 3 or 4%, but then they take it away 1.5%, 2% in fees. So you really don't get as much as you'd like. Now, there are a little bit higher rates with this program, but again, you kind of have to balance out, is it worth it for, up against, say, a traditional FHA or conventional loan? That's my job. I'll definitely educate the client on what's the best route to go. But I think you should kind of have this as a talking point with any of your customers who may have limited down payment funds. And again, we're going to talk about it more because we think it's a good option for our customers. So, check it out. I've included a flyer in this email video, as well as that short little video I talked about regarding interest rates. So I hope you appreciated this update. My name is Nathan Davis, 239-898-8841, or you can catch me through my website at agentslender.com. Have a great weekend.